Well, thank you everyone for coming. We had a very animated conversation before we walked in here. And given normally I stand up here and make students fall asleep, which I hope I don't do with you. And so I couldn't help but get a marker and write things on the board, which is what I've done here, to try and structure the conversation, which will last all of 3 minutes before it falls apart. What we are trying to do is stay at a high level. We're trying to talk about the process. We're trying to talk about how you manage this process, how you think about it. In terms of questions, we'd much prefer that you keep your questions up at the process level rather than questions directly aimed at people about individual companies. That's not the aim of this panel. Because we have real life experience here and it's a real thing. So the idea we basically came out with was to start with the ideation process. What are you trying to do? What are you trying to achieve? The reasons for doing it. Then this whole interchange between building the technology, designing the technology, and designing the strategy of how you're going to roll that technology out. Are you going to use a token at all? There may be good reasons to use it, and there's probably lots of reasons not to. Then we're going to go on to the whole process of building community. We're going to have a fairly animated discussion about when you build your community. We're going to have an exceedingly animated discussion about what you say to whom when. And I'm going to next move, then we move on to the fundraising, and we can talk a little about that. And then the final bit, which is actually generating the tokens and that process, we're going to spend relatively little point starting. But I'm going to turn over to Caitlin and ask her to do her legal warning to everybody about this process.
Oh gosh, well, I'm a non-practicing attorney, and having worked on the Wyoming Blockchain Coalition utility token bill, the one thing I can say is that you really do need to be speaking with an attorney early on in the process. That was the animated discussion that we had about where it fits in that process. And that's probably the biggest piece of advice that I will give, which is, of course, not legal advice, which is talk to an attorney before you publish anything. Because anything you say, even on your Telegram posts, your Twitter posts, could be deemed marketing a securities offering and could be deemed a general solicitation that will have an impact on your project down the road, even if you inadvertently trip over these lines. You just need to talk to an attorney before you get started on anything public. I think we agree on that.
Yes. Yeah, I think that, as a platform, we don't even really talk to any issuers or people who want to run token sales without them telling us who their counsel is and vetting that counsel to make sure that they've gone through the legal recourse of making sure that they're buttoned up. I just to kind of be very clear, like there's a lot of gray area when it comes to regulatory sides in this market. I'm sure all of you are aware. There have been statements by regulators. There have been issuers that have done certain things like this way or the other. It's not really clear. So getting guidance from a legal expert is by far the best thing you can do. When you seek that legal guidance, we're going to discuss. But we absolutely encourage this.
Do you want to just quickly explain your background and what Indiegogo has been doing?
Yeah, so Indiegogo, we've actually been around for 10 years. We're one of the world's largest crowdfunding platforms. When we started, the ethos of Indiegogo was actually really to create a platform where people around the world could invest and contribute to projects that they were passionate about, whether that was a local pizza shop, whether that was someone building a robot, whether that was actually a long-term business. We always, when we were founded, equity crowdfunding was actually our original goal. And in 2015, with the passing of Title III of the Jobs Act, we actually got to see that become a reality here in the United States. In 2016, we launched our equity crowdfunding platform with a compliant token sale platform, or a compliant equity crowdfunding platform with a broker-dealer license. And then late last year, we converted that platform to a token sale platform. So we can actually do compliant token sales, both security and utility. Utility assuming that you meet our threshold of what we deem to be legal. But ultimately, we do want to create a platform where people who are doing token sales can do them in a compliant manner, reach out to both accredited and unaccredited investors, and see this industry take off, because we're very, very passionate about the concept of token sales and the concept of equity crowdfunding and raising capital from enthusiastic people around the world. And so we hope our platform kind of creates a framework for people to do this in a really great way.
Do you want to talk about what you're doing and where you come through in the journey you've been on, just to give a little bit of context?
Oh, geez. Well, the panel's only 40 minutes. But in any case, yeah, so I kind of come from a different side of this. My husband and I co-founded Tezos together, which is a blockchain, based smart contract platform akin to Ethereum. There's a lot of ideation that goes into actually constructing this and the nuts and bolts. So I can lend some technical knowledge to this, but really Caitlin and Evan have probably forgotten much more than I'll ever know about the regulatory side of things. So I'll let them take that aspect of this.
So why did we start talking about this whole ideation and reason process? Because this is where we had most of our discussion, which is where we think that people should be spending their time at the very beginning, working out what to do,
right.
what you're trying to do with your company. And it's the same when you teach entrepreneurship. You're asking people, what problem are you solving? And it's easy to get lost. Who's the customer? What problem you're solving? What's your minimum viable product? All of those pieces. And you need them, and you need them right at the beginning. That's why it's at the top, why you have the token generation piece at the bottom. And what we see a lot of is people starting with the token generation and then backfilling everything else in behind.
Right, yeah, in general, I think people have seen tokens have strong network effects. Therefore, if I make a token, it'll have a strong network effect. I don't think so. But I digress. With Tezos back in 2014, there was sort of a Cambrian explosion of altcoins based on forks of Bitcoin. And the thinking there was this is excellent because Bitcoin will just be able to fold in all the good parts of these other tokens. My husband and I observed this, and we were like, but how? And so that was the looming question. So what the developers came up with was essentially a very abstract blockchain that can sort of self-amend, meaning it can fold in new aspects of the protocol rather seamlessly and push out those upgrades in a decentralized fashion, meaning you don't have to have this sort of game of chicken coordination that most other blockchains suffer from when they want to do any upgrade, no matter how big or small. So that was the gist behind Tezos. The problem we were trying to solve was coordination and governance in a blockchain. And the tagline for Tezos is a digital commonwealth. And I really like that idea because it's a shared resource amongst many different people. And so it's up to the consensus of the governed, if you will, to come up with what they think that best permutation is. So Tezos, it's been in the works for the past 4 years. We're preparing to sort of launch the network more properly in the next few weeks, next few months. And there's a lot of considerations that go into that as well. So I'm happy to kind of talk about the tension between using a proof of stake token versus a proof of work token, because the distribution of the network is much different.
You talked about tokens. Perhaps we can just have a little discussion about the different type of tokens we can have versus security versus utility versus, and why that's a critical thing to decide early on. Do you want to talk, Caitlin, about the legal aspects of how it feeds through, and then?
Sure. Well, utility tokens are a concept that has been created by this industry, but doesn't, with the exception of the state of Wyoming, exist in the law. Wyoming was the first state that actually codified the concept of a utility token as being distinct and different from securities and money, and therefore not subject to the regulations of either securities or money in the state of Wyoming. Under federal law, I just was at a government blockchain conference, and Valerie Shapanik, who's the head of the blockchain working group at the SEC, actually said something akin to utility tokens was a concept that was created by people who wanted to figure out how to avoid securities laws. It was quite a negative statement, and I don't think that's true. But the reality is the SEC, you've heard Chairman Clayton's statement that he hasn't seen a utility token that wasn't a security yet, is the operative word. He didn't actually say yet, but at the Princeton event yesterday, he did open the door for the first time publicly that once a security token is issued, it may not always continue to be a security token. They've not issued any guidance as to how a security token could change stripes. Evan and I were talking beforehand. It's clearest if you just do a traditional securities offering at your crowdfunding stage under Reg A Plus and Reg D, and when you do your token generation event, that's when your platform is up and running and the token is actually exchangeable for goods and services. And at that point, you have a much better argument, and under the Wyoming law, very likely you would qualify under Wyoming statutes as a utility token. The challenge is that you can trip up in the early stage very easily, because if you market your token as an investment, you're in securities land, even if it's purely like an airline mile or a gift card, something that's exchangeable for a consumer good and doesn't act like a security. One challenge about the securities tokens, one other thought on that. I've been pretty vocal I ran the pension business at Morgan Stanley. This industry, which is going in the direction of saying, well, let's cause all utility tokens to be considered securities tokens and just throw in the towel and consider them to be securities. There's a major problem that securities tokens are going to face, which is that the clearing and settlement infrastructure of Wall Street is not designed to integrate with a blockchain. And by acknowledging up front, just for your crowd sale, that you're a security, that puts you in a very gray area when your platform is actually operating. Because by definition, your token is only trading on a blockchain. And interesting question is, do you have to, if Starbucks issues Starbucks coin, for example, which Howard Schultz publicly said they were considering. Let's use that as an example all of us can understand. Obviously not done yet, but let's say that is operating. The question is, are you going to have a Charles Schwab account to buy a cup of coffee with your Starbucks coin? It's a very real question, and in fact, actually, Kodak issued an 8K, which is an SEC filing that talks about material information, and added a warning to its ICO documentation that by issuing it as a security, that may significantly impair its ability to build its network, and that it's not clear that the clearing and settlement infrastructure of Wall Street will ever trade this, even though it's a security. So I like the Indiegogo strategy of keep a bright line between securities, and then you retire those securities when you do your token generation event, and that doesn't happen until your platform is up and running. But all that said, you still have to be very careful in that early stage about describing how your token what your token is going to look like, because you may fall into the securities regulation just by nature of the fact that you're marketing it as an investment.
So when we talk about tokens, we ought to split in two ways. Why we generate a token, and one of which we talked before was your point about community, and then your point about raising the...
Fundraising.
Yes.
Yeah.
So which order do you want to take it in?
Go ahead, Evan.
Yeah, I think that in the ideation phase, this is one of the most important parts of actually even deciding to do a project or not, is really figuring out what the token represents. What we're really excited about on the utility token front is all these new business models, all these new governance models, all the things that you've seen in some of these protocol level tokens that are groundbreaking pieces of technology that everyone has been excited about. I think that we can all agree that most of us are here because these technologies are really exciting and they have a huge long tail that ultimately will define our industry. If you're building a token like that, you really have to understand what the value of the token is. Because I think a lot of people that are using these, going the route of utility tokens, are making this claim that the token actually has a demonstrated utility, but when they discuss it with people in the pre-sale phase, it still feels like an investment, and thus the SEC has made the issuance that if it feels like an investment, it's likely a security. Now there's the other side of the utility tokens that we've seen where people are just calling it or creating out of thin air a utility for their token just so they can skirt the law of security and raise capital. And that's a different story. And so when you're doing the ideation phase, you really have to think, does my token actually have a purpose? And you'd be surprised how many projects we've seen that it really doesn't have a purpose. Really, they've just put some sort of label of utility on it just so they can call the utility token so that they can raise it in an unregulated manner from people around the world and raise capital. And this is exactly what the SEC is really worried about, is that people are just kind of skirting the law and calling these utility tokens for that namesake. I don't believe that all utility tokens fall into that realm. I think there are absolutely projects out there that have real true utility that can use these business models in a brand new way that are going to totally change everything, and that's what we're really excited about. But in the ideation phase, when you're building your token and you're deciding what your structure is going to look like and how the model is going to work in terms of incentives, if you ultimately decide that this token can exist without actually, or my business can exist without this token, probably should not consider doing a utility token sale.
Well, I guess my point is completely tangential off of that, but yeah, no, with Tezos, it's an interesting case because the Tezos token can represent a number of different things. It can represent computational power in the network. It can represent your voice in deciding upgrades, and it can also represent transfers of data between different parties in the network. So giving the network a way to kind of participate in 3 different ways is particularly special and kind of interesting to us. So that's really where the importance of community comes into play, and having a large group of people kind of competing and using it in different varieties for different use cases is paramount.
So can you talk a little bit about how, if we believe in this network effect and we believe that the more widely spread the tokens are, the more valuable the underlying network is, can you talk a little bit about some of the different ways that out there?
Oh, like different use cases?
Well, for example, airdrops versus other ways of pushing out what's... My understanding is that effectively you want to have the tokens spread as widely as possible because you're building a user base.
Yeah.
You want to provide an incentive for them to be spread widely, and when you're designing it back to this whole ideation reason point, you're trying to work out how much it's worth pushing the coins out there to build community, as opposed to holding the number of tokens tight in order to drive up your rate.
Well,
Go ahead.
I think Evan's point is actually more pertinent here because it goes back to what does the token represent.
Right, Go ahead.
Yeah, and so I think that the term token economics or tokenomics is thrown out there a lot, and we're not really fond of it personally, but what I like to think is that a lot of people who are doing these utility token sales are doing them in this sort of Reg D fashion, in which they're calling them a security, they're raising them like a security through a securities exemption, but ultimately they're defining them as utility. But when you raise in a Reg D fashion, which is a securities exemption, you're selling them only to accredited investors. And what we're seeing is that you're selling millions of dollars worth of your tokens, but only to a small group of people, which doesn't really give you that sort of utility as wide use range, which a lot of people are claiming. So I think that what's really important, again, going back to your ideation stage, is that at the end of the day, you want to have the token in as many hands as possible, being used by as many people as possible. You should make sure that you do your fundraiser in a way that it reaches as many people as possible. And if that means that, hey, I need to wait till my network is built so I can sell them to unaccredited investors around the world, that's probably the best way to go. And I think we're going to talk about strategy in a second, but it is really important to kind of go that route.
Well, that's a perfect step up because we've been throwing around terms like Reg D as if it's going out of fashion.
Well, it is going out of fashion.
So could somebody take a quick stab at giving a list? First of all, there's a regulatory framework in the US, and then there's a whole different regulatory framework in the whole of the rest of the world. And there's competition between these two about where you would aim your business and where you'd raise money from. So who would like to talk a bit about this? And it comes to this whole idea of where do you want to aim, where do you want to build the people? Who wants to talk about the Reg D Security Exchange push in the US? And then can you then also go on to talk about how Indiegogo, being a crowdfunding platform, has an access to a different group of investors?
Sure. So just to be clear, like when you're doing a security token, the fundraising process is incredibly different than doing a utility token sale. Mainly because, as Caitlin just mentioned, the concept of doing a utility token sale doesn't exist in the regulatory framework in anywhere in the world except for or anywhere in the States except for Wyoming. So going to if you're going to do it in a regulated way and you're going to do a securities offering, there's a very tried and true method of doing this because people have been doing securities offerings for decades. And that is either filing directly with the SEC or using something called a regulatory exemption, which is essentially a state of rules that says if you want to offer this token to certain people and raise money, or offer this security, I should say, to certain people, you need to follow these rules. And right now, the most popular exemptions are Reg D, which is selling an unlimited amount of capital to registered or to accredited investors here in the United States. And to be an accredited investor, you have to have an annual salary of $250,000 or a net worth of $1 million plus. Or you can do a Reg S, which is selling to anyone outside of the United States. There are some caveats to that I can explain in a second. And then with the Title III of the Jobs Act passing in 2016, the SEC sort of opened the door to selling securities through a securities exemption to unaccredited investors through either a Reg CF, which stands for Regulation Crowdfunding, which means you can raise up to $1,070,000 from unaccredited investors here in the United States, or a Reg A+, which means you can raise up to $50 million from unaccredited investors here in the United States. Again, this is something really that's important to talk to lawyers about because depending which exemption you use will determine how you can market and who you can sell to. Some caveats about the Reg A Plus, just to be clear, is it does require a lot of disclosures. It's like we call it a mini IPO, so it's similar to a S1 where you do have to do things like a financial audit, you have to do quarterly reportings, and you do have to be very transparent with the people that you're fundraising with. And we do see some people that are doing token sales that want to do this Reg A Plus structure don't necessarily have the history of their business to make it possible. So those are sort of the regulatory frameworks. Through Indiegogo, we actually have a platform that allows people to do all of those things. So to do a regulatory filing, especially the Reg A Plus, the Reg CF, you have to have a broker-dealer license, and you have to use the registered funding portal with FINRA. Indiegogo is those things, and so we help companies navigate these sort of frameworks so that they can do a fundraise in a proper way and not end up going to prison, hopefully. So that's kind of what we try to offer. And if you're going to do a utility token sale, you don't necessarily have to follow these frameworks. We are seeing people doing utility token frameworks and following these frameworks because of just trying to protect themselves should the law actually say that all of these utility tokens are securities. But ultimately, if you're going to do a securities race, you have to use these exceptions.
A couple additional thoughts here. I saw through the Wyoming process all of the email traffic, and there were thousands of inquiries during the Wyoming process. And one of the unfortunate things that kept coming up again and again is I'm trying one last time to keep my business in the United States and do it in a compliant fashion. And if I can't figure out how to comply with laws in the United States, then I must go. The most popular place where they were all going was Switzerland. And the reason why Switzerland is interesting is FINMA, which is the financial regulator in Switzerland, actually came out. It worked out timing-wise very, very interestingly with the Wyoming legislative process, because they came out in February, right as the Wyoming process was underway, with very clear guidelines. And so you actually have rails in Switzerland that make it clear how you should be operating. And I must say it is really unfortunate because it's clear that federal securities laws are not consistent with the idea of a community building process in a decentralized token protocol. And that's a fact. It's a sad fact, but another sad fact is those are the laws. They were obviously not built for the platforms that we have today, but they are the laws. And if you run afoul of them, you take significant risk both for your company and for yourself personally, both civilly and criminally. So it is really important to work with an attorney, and I think the industry is also going to have to take some action congressionally to get some relief, because as everyone was talking about, some of these things just don't quite fit, right? Having to do quarterly reporting and audited financial statements for a startup just doesn't make sense, right? But that is how Reg A Plus works. And if you're going to do a fully registered securities offer, you have to have 3 years of historical audited financial statements. That doesn't work for a startup, right? So there are things that just don't fit with this industry, but unfortunately, they are.
Yeah. Can we talk a little bit more then? Obviously, we talked about US focus. You just touched on the international scene. So we have Estonia, we have Canada, we have Gibraltar coming
Malta,
in,
Singapore.
Japan, Singapore, yeah.
Yeah. So what is their approach and why are they different from the US? Can we talk a little bit about how the US has a decentralized regulatory system and the others have a centralized, and how that complicates things? Or maybe we should just simplify and say each one of those countries have their act together.
I just came back from Korea, where I spoke with a lot of companies that are looking to do token sales, and the general consensus is that they want to sell to US investors, but it's very complicated because of our regulatory structure, and they have been advised by legal experts in their native countries that it might be better not even to raise from American investors. I know that the regulators here don't want that to be the case. They don't want to stifle innovation. They want the United States to be the place where this sort of innovation happens. I know that's probably the efforts that you guys are trying to push forward. That, hey, how can we make the United States a central part of this industry? I would say today's landscape is probably not the best fitting for the United States. Those other countries have been a little bit more progressive. I would like to say that some of the feedback that I heard was that Those countries, obviously, they're much smaller. Their economies are much smaller, and because they're smaller, they don't deal with the amount of fraud that does exist here in the United States. So their regulatory agencies aren't as focused on protecting consumer investors because consumer investors aren't exposed to this much fraud unless they haven't seen it as much. I think that it'll be very interesting to see what happens over the next 12 months. As Chairman Clayton said yesterday, it seems like the purview of regulators is opening up a little bit as they realize that more and more strong, qualified companies are taking their sales off-site and offshore.
Leaving the U.S. entirely.
Yeah. And that leaves a lot of U.S. investors hanging dry. So I think that will change. But I think to answer your question, the reason why these other countries have got their acts together is just they're more progressive and they have less to lose. The SEC, when we spoke with them, they said, listen, like the rest of the world looks to us to be as a leading example, and they don't want to, take one wrong step and lead everyone the wrong direction. They would rather take their time, evaluate everything, facts and circumstances, case by case, and come up with a really strong understanding and a really good regulation if they're going to do that. They also were very focused on self-regulation. They said, hey, if the industry can self-regulate itself, it's going to be much better than us doing it, because if the SEC regulates, you're not going to like it. And worst case scenario is that the SEC doesn't do anything, this entire token sale bubble bursts, and Congress does something, and now you have Congress passing regulation, and that will probably be the worst thing that happens. So they advised us as a platform, hey, work with the other people in the space and try to create a self-regulatory body and create rails for this industry so that when something does happen that's negative and it possibly takes the industry on a nosedive, people still feel confident in investing in the future and that there are guidelines for doing it in a proper way.
So if I wanted to go off and raise my money and do it in Estonia,
sure,
how much time should I allocate to that? What sort of the complexity of it?
Well, why would you want to do it in Estonia just because of the regulatory?
Well, let me give the example, which is I could do it, if I'm not going to be in the US, I could do it in Singapore, I could do it in Switzerland, or I could do it in Estonia. Switzerland tends to be really expensive.
Yeah.
Because you're playing Swiss lawyers.
Sure.
Estonia, there's Gibraltar, but Gibraltar's pretty new into this whole space and they're just creating their framework. Estonia is relatively cheap, relatively fast, and speaks English to overseas.
I think that a saying in the legal world is cheap is expensive. I don't really recommend going to the cheapest place possible just because it's the least expensive and you can do it the quickest. I think that given this is a business that you plan to run long term, you should do it right and talk to quality lawyers, talk to quality counsel, talk to people that have done it before in that. If you're going to go into an offshore mode, talk to companies that are in that market already and what are the issues there. There's no place in the world where everything is fine and dandy. Every country has their pros and cons. But I would say that if you're going to choose Estonia or Switzerland or Singapore, understand that that's where you plan to build your business long term, and that could have repercussions if you want to have a global business in the future.
So we've talked a little bit about the SEC, but there are other people who get involved in this. There's Know Your Customer, and there's a series of other bodies that are involved. Can we give a quick run through of who people should pay attention to? Not just the SEC. There's FINRA. Should we just give a quick list so that?
Sure.
U.S. setting.
Well, the first decision you'll have to make is which state are you going to set up your business entity. Delaware is the state where historically most businesses have been formed, but it's not the cheapest by any stretch. And for startups, it's actually not as friendly as other states. That's where most of the established companies are situated, but they care a lot about having the Delaware Chancery Court, which is a business litigation court, and so they're willing to pay up for that. As a startup, the one thing you need to know about Delaware is that they assess franchise taxes. So it might be cheap to set up a business entity, but they do assess franchise taxes. My native state of Wyoming, where we got the Wyoming blockchain bills passed, is by far the cheapest state to set up your business entity. It also has really interesting privacy aspects for LLCs because the Secretary of State does not collect the information. So even if they get a request from Washington, D.C. to share the identities of all of the members of your LLC, the Secretary of State doesn't have it to share. There's also no income tax in Wyoming, so there is no tax authority to share income tax information with the IRS. So Wyoming's been historically a really interesting destination for asset protection vehicles, and I'm pretty confident it's going to become the go-to place. It already is from the traffic that we're seeing for businesses that set up legitimately in the United States in the crypto area. There's no income tax, no property tax, and we also passed a bill that exempts crypto from, no income tax, no corporate tax, no franchise tax, and exempt crypto from property tax. So that's states, but that's your first and actually your most important decision. Then the next decision is all the SEC, which we've talked about at great length. You may be a commodity depending upon the structure of your coin. Again, this is where a lawyer can help you. And you possibly will have to do know your customer and anti-money laundering. That's not clear. I think that the platforms that are set up to do investor screening are set up to do know your customer and anti-money laundering, just in case you do have to comply with it. And there was a letter sent by FinCEN to a congressman implying that all ICOs need to do AML and KYC. That is not actually regulation, but I think a good lawyer is going to tell you, keep those records just in case.
Absolutely, and accredited investor verification. So if you're going to do one of the regulatory exemptions, you have to, if you're going to sell to unaccredited investors, you actually have to do the KYC and AML. If you're going to sell to accredited investors, you have to verify that they're accredited investors, and they have to prove that, and there's a process and a formula for doing that as well. All the platforms generally do have that, though.
Can I slow you down? KYC, they all sound like different forms of fast food.
Yeah. KYC is know your investor. AML is anti-money laundering.
So what is know your investor?
It's basically a way for a company when they are raising capital to have a little bit of information about who these investors are. Generally, you have to submit a passport and an address, your name, some verification to just ensure like who this customer is, where they're a citizen from, where they can be reached, and that's logged in the investor rate. AML, it's mainly just to determine where the funds come from so that there isn't money laundering involved. How you do this on the blockchain is actually a really big question that a lot of people have been trying to solve that isn't clear yet, because a lot of especially if you're moving coins back and forth between exchanges and you're using private coins, it is a lot harder to determine if money is being laundered or not. But it is still a process of raising capital, especially from unaccredited and accredited investors. And then the accredited investor verification is just sending information about the investor, and they generally have to send some sort of bank statement or W-2 verifying their income level or their bank statement to say that, hey, I'm wealthy enough to lose all my money and not worry about it.
In other words, all of these things are make it very difficult for you to build a community of global retail, regular folks. Again, U.S. laws are not consistent with that.
So we mentioned fundraising. Can we talk a little bit about whether you would raise fiat currency via credit card, whether you would convert from Ethereum, Bitcoin, all those pieces? It could be.
So our platform, we allow people to take fiat, Bitcoin, or Ether. We think that it ultimately depends, again, how you structure your token and your business. If you're running your entire business on Ether, you might want to only accept Ether. Obviously, companies that did token sales strictly in crypto are probably feeling it today as the market's cut in half over the last 3 months. But at the end of the day, determining which currency you take is probably just trying to figure out the least amount of friction between getting capital in the door or not. If you take fiat, just know that there's a whole slew of things you have to do with your bank to make sure that you comply. So because you're taking in fiat, and thus if you're taking money, you should definitely make sure you have your KYC, your AML, and your accredited investor verification, because the bank could shut you down for not having that. But at the end of the day, I think that it's up to the issuer themselves, depending on how they're going to build their currency out. I don't recommend, as a business owner, to keep all of your raised capital necessarily in crypto, mainly because of issuances like this, where if you're running your business in a country where you have to pay rent and pay employees and pay taxes, keeping your money in crypto just essentially puts your company at more risk, because you could lose you're basically gambling away your income.
So why don't we just move to the token generation event and then open it up for questions?
Sure.
Quick, right?
Do you want to talk about it?
I mean,
Okay.
I suppose like with Tezos in particular, it's a fresh new implementation of a blockchain that uses proof of stake. Essentially, what this means is that the beginning, the origins of the network are extraordinarily important, because there's no elegant dispersion of new coins like there is in proof of work or in Bitcoin. The early days of Bitcoin, people said, oh, it's great, you can either buy Bitcoin from someone else, or you can start to become a miner, and that's how you can get access to the network. And indeed, that's how many people start to participate in it. Now it's a little bit more prohibitive in terms of cost to do that the second route, but nonetheless, with Tezos, what we think is imperative is to have a lot of people sitting at the table at the origin of it, because it's basically the chain is validated through an inflationary mechanism, whereby if you are already participating in the network, you have a bit of an advantage. So for Tezos, it's important to do that at the forefront, but many other projects have different elements, again, to Evan's point, like based on what the token represents.
Yeah, it really depends on which kind of token you're doing as well. Some people, well, if you're doing a security token, you can actually generate and issue that token immediately after the sale because it's pre-sold and it's a security. How you issue that token, whether you do it on a security blockchain, whether you build in the smart contracts for trading, is really important. And there are some solutions out there. There's some exchanges out there that are building protocols for security tokens, things like Templum and T0 and Polymath. I encourage you to look at a bunch of them because everyone's got a different structure. For utility tokens, our guidance is if you are doing a utility token sale, we really do recommend doing that utility token sale once the network is built out, because if you are doing it prior, it's likely to be a security just because the network isn't built out yet, and thus the SEC can make the argument that you're investing into something that doesn't exist, which feels like an investment. If that's case in point, either way, if you are doing a TGE, you should really, even if you've raised money beforehand, someone like Filecoin where you did a SAFT or something like that, the goal here is really again, issuing the tokens once the network is built out is really key, because if you've issued the tokens out prior to the network being built out, it feels a lot more like a security, because basically you're selling utility tokens, but then when the person receives those tokens, they cannot demonstrate utility. And if you were to be litigated in court, you'd have to defend that. So what we do really recommend is, if you're doing a TGE, wait for your network to be built out from a utility standpoint. If you're a security, you can generate that token as soon as you want, after the sale.
We have 5 minutes left for questions.
So I have a question about this particular issue you raised, which is selling tokens for a future endeavor that hasn't really taken place yet. If I look at what's happened with Bitcoin Core, where you have an initial, the initial coin, if you will, with some utility of its own, suddenly turning into, through a narrative change, into what was called a store of value. And then suddenly the entire coin is essentially, at least by some perspectives, it's some kind of a security for the Lightning Network that is yet to emerge. So how do you view this from a regulatory perspective? What happens when a token changes shape? And how do we reason about tokens that are initially utilities and then turn into securities?
That's a great question. And so, to be clear, the SEC has ruled that Bitcoin is not a security, mainly because it was not pre-sold. The network launched, and people could buy and purchase them and mine them, and the network was never pre-sold. Thus, nobody actually invested into Bitcoin and expected future value in the future without receiving anything. They actually just received the coin and it accrued value over time. To your point about Lightning, I would make the argument that you're not investing directly into the Lightning Network. Thus, it wouldn't be a security. You're investing into the Bitcoin network, correct? Bitcoin is not, Lightning is not, it's a channel. It's not necessarily directly into the business. There's a test called the Howey Test, which is how this SEC determines what a security is. You could probably go into it more specifically than me, but I would say that for the Lightning Network, you're not investing directly into a common entity, which would be part of the Howey Test there.
So one of the early observations about ICOs was that one of the value props is you can incentivize your early adopters to become stakeholders and investors. But now it seems like the push is towards basically an unbundling of those functions into kind of multiple native digital assets on the same chain that serve specific purposes, right? One is security, one for governance, one for access. Do you still see that value prop as something that is still feasible? And do you see any creative ways of people making that happen through some sort of interplay between the security token that gets retired and the PG?
I certainly do, but the way to handle it right now is to do it offshore outside of the United States. In the first stage, do it in Switzerland where it's clear what you can and can't do in that first stage, and then come back onshore in the second stage. That's where the Wyoming law gives you very clear, good clarity in the United States. And talk to the SEC. Again, you will have already heeded our advice to get a good lawyer up front to help you navigate all of this. But then once you talk to the SEC and lay out, you're not coming into the United States, you're not selling anything, so you're going to be geofencing in that early stage. You're not going to be raising money from the U.S. investors. But when you do your token generation event, if it truly fits if it's outside of the Howey Test and you did not sell it as an investment, then you have a good case. And I would also encourage everyone to talk to the SEC. I've heard from the attorneys who are practicing in this field. The SEC has been surprisingly favorable toward companies that do come in and work with them. They have been very critical of companies coming in too early with half-baked ideas that very clearly did not work with good counsel. But those who actually had good ideas, I'm hearing from attorneys just even in the last week that the SEC has actually been much more favorable than you might think.
One last question. Straightforward.
Just to move away from the regulatory aspect and more on the practical side for someone that wants to do an ICO. So if you compare to IPOs, you have a whole bunch of advisors that tell you how you should price your equity and how you should go about the whole process. For ICOs, are there any guidelines for startups? How do I price my tokens? How many tokens do I give people? Are there any standards or anyone that's thought about this problem?
You might be able to go into it more than me.
I mean, Reddit has a lot of opinions.
Yeah. It goes back to your ideation, right? Like, what does the token represent? What is its value? How much you're trying to raise? Why are you trying to raise it? Every single issuer is super different. So there isn't like a clear-cut, cookie-cutter way to do it. So yeah, I wish Reddit has a lot of opinions. I would recommend consulting some sort of economics scholar to understand your overall token model to see if there's actually incentives on all sides to make sure that the market doesn't just crash when you launch it.
You want to quickly see what's happening to your coins. Your coins always exist. They get destroyed, they get created. Look at your ecosystem. So map out your system and then decide what it is, what process is going to create revenue that's going to drive your business. What process is going to create a good or a service that's going to be sold. So you need to do a system map. Once you've mapped your system, once you've worked out the velocities through it and numbers of people, things like that, then you're going to get the numbers coming out. So start from the bottom, start from that whole why you're doing it, what the technology is, what the structure. Once you've done all that, then as an engineering problem, then you're going to start to see how many coins you need and whether you need to recreate them or not. For example, a stable coin is very different from one where you're trying to drive an increase in valuation. One where you're creating file storage is going to be very different from one when you are backing it with diamonds. I'm sorry, that's all time we have for. Thank you for everybody.